Welcome to the InterMarket Analysis video update. This is a video that I do once a week, and even though it says InterMarket Analysis, there's some other areas that I look at in this video. I look at the valuation of the S&P 500, both on a historical basis and on a forward-looking basis. I also do a pretty in-depth study between growth versus value, and then we look at other markets in the stock market and outside of the stock market, because sometimes we can get some clues as to what's happening with the S&P 500 based on what's happening in other markets. This is being prepared for Monday, June 17th. Please know that I do have a program called the SPXInvesting Program. It has now launched. There is a link to find out more about the program. I have a playlist on YouTube. There are a series of videos on Rumble. I can't do a playlist there. If you want to talk to me about this, here is an email address where you can contact me directly. And there's also a link to get to the platform where the SPX Investing Program is located. It's free for the month of June. I'm probably going to lock it down in July. It'll be $97 a month. But there's things that I talk about for ways that you can take care of that monthly fee if that interests you. The first area that I'm going to go in and look at is the S&P 500 valuation. We first look at historical earnings that have been released and compare them with price. There's a thing called the PE ratio, the price to earnings ratio. When this gets really high, that means the market is overvalued. When this gets pretty low, that means the market is undervalued. We have a PE ratio of 20, 15, and 10, and then the corresponding dashed lines. The red dashed line is the PE ratio of 20, and we can see the price is well above the PE ratio of 20. So when we look at this on a historical basis, the market is expensive. But you can look at this over time, and it can last many years in this type of a condition. We don't use this to make decisions. We look at this just to say, okay, now I know that the market on a historical basis is considered to be expensive. Down below, I have a breakout of the current price of the S&P compared to the red dashed line. This is also going up and also suggesting that we're looking expensive. We take that same basic concept and then go all the way back to 1980 and then different events that have happened along the way, and then what those valuations were at that time. You can also see here that we often spend a great amount of time above the red dashed line. That's not necessarily negative, and it can last for many years at a time. But some people, this is really important to them, and they keep thinking that the market is overvalued, and maybe they're not getting in because of that reason. So we don't use it as any kind of a timing mechanism. There's a variation of the PE ratio called the Shiller PE ratio, which looks at things over a period of time. It takes more of a smoothed approach. This was developed by Robert Shiller. It's been very useful to us. We see the current reading over here is 35.37. All right, well, what does that mean? One way that we can get context is by looking back all the way into the 1800s to see what the value of this ratio was compared to what was happening with the S&P 500. We can also look at the median and the mean for this. And the median is a little bit over 17. The median is a little bit under 16. So we say between 16 and 17. That's well over double what the current value of the Shiller PE ratio is. So this also confirms that the market is expensive. Again, not to make decisions based on this, but just to know of the overall state of the market. There's another chart that I ran across this week called the Shiller PE, a long-term view. This is actually putting some standard deviations on this chart. We have a standard deviation of 1, and when we get above that, these yellow lines, that means we're very overvalued on a historical basis. We've been that way now for quite a while. Here's the whole COVID crash and then the bounce up out of that. We did drop below it when we had that difficult time in 2022. Now we're starting to go above it again. Again, if you try to use this as a timing mechanism, it could be years before what you're seeing here can actually play out. The market doesn't do that, though. It looks forward based on PE ratios, and I get this chart from Yardeni Research. And this is a little bit different if you've watched any of these other videos. I've actually included an additional calculation. This is the mega cap 8 looking forward as of June 14th. We're up at 29. Well, we use that same basic 10, 15, 20 scale. And so this is suggesting that we're overvalued even on a forward-looking basis with the mega cap 8. Again, this has gone on for quite some time. So it doesn't necessarily mean things are going to turn around. It just tells us where things are at. The red line is the S&P 500, and we're above that 20 level at 20.8. So even looking out into the future, we are still overvalued. Then we look at the mid caps and the small caps. The mid caps are the blue line here, and that's actually under 16. It's coming in at 14.8, just a little bit even under 15. So that's considered to be fairly priced right now. And then we look at the small caps, which have really been a disappointment in 2024. They're under 14. They're coming in at 13.9. Be aware, if you use this as some kind of a model to determine when you get in or get out, because the small caps have been just chopping sideways in 2024. Technically, they're not doing very well. When I mean technically, I mean using technical analysis, looking at charts. We want to see some growth, and the small caps have been in a range, and they get to the top of that range and then come back down. And we've seen that now going on 6 months. So be careful with that. But this is still valuable information that we want to know about. Now, the next area I look at is growth versus value. Growth is when you want to buy a stock at 10 and sell it at 20. You want the value of the price to actually go up so that you can sell it as a profit. Now, value, on the other hand, this is a more defensive type of investment. These are typically types of stocks and areas of the market that people get into and the smart money gets into when it looks like we're going to have some difficult times. We could either be going sideways or actually have a decline. We saw value really doing well in 2022 as the market was going down. Since we bottomed and have been going back up, we're seeing an improvement with growth. We want to see it continue because some of these relationships are not really strong right now. The first thing we look at is just the pure growth index. This is growth all by itself, and we are in an uptrend, and we're above both of the moving averages. So that's looking positive. But we also have value that's in an uptrend itself, but it's dropped below its 50-day moving average. And this is why we're seeing growth outperforming. We're seeing a bit of weakness now with value, a bit of strength with growth. Then we take some ratios. I have a growth to value ratio on top, and you can see we're really starting to show an improvement here. On the bottom is an inverse of that same chart showing how value is underperforming. The reason why I use a lot of different charts is you can see this arrow when we saw a moving average crossover, there's a little bit of a time offset here. We want to make sure if we're using this to evaluate the market that we're seeing the same information at the same time. And so we use a lot of different charts to confirm that. I also look at some ETFs. This is a longer term chart showing how growth is outperforming value. Then this is an inverse of that same chart, and it's confirming that value is underperforming growth. We look at those peer growth indexes again, but this is a longer term chart. When this is going up, that means growth is outperforming value. Then this is a shorter look at the inverse of that previous chart, showing how value is underperforming growth. So we look at this in a lot of different ways, and we're seeing pretty much a lot of confirmation right now. Then we look at another growth to value ratio here, showing how growth is outperforming. We look at a couple of ETFs, a growth ETF and a value ETF. When this is going up, that means the growth ETF is outperforming, and it's actually doing quite well these days. Then we look at an inverse of that same thing, showing how value is underperforming. Then we break it down a little bit. We look at just small cap growth to value ratios here. This is showing some improvement, but not an awful lot of strength right now. Looking up here at the top, you can see where the small caps for all of 2024 have been in a range. We get to the high end of this range, and then we start to go down. We get to the low end of this range, and then we start to go up. Now, if you're a short-term or swing type trader, you might like this kind of an environment. But if you're in this more for the long haul, this has been really frustrating for you since the beginning of the year. Then we also look at mid caps, which are a little bit of a disappointment now. Back in about January, this really started to break out and show some strength. And at some points along the way, mid caps were the strongest area of the market. Well, then we started to pull back as we were still going up with the index. And now we're seeing a little bit of weakness again with the mid caps. And this ratio is doing okay, but we've just seen a recent death cross with this ratio. But we want to see this continue to go up to be more positive on the mid caps. This is the one that I focus on the most because this is S&P 500 growth of value and taking a ratio. We're finally breaking out above these previous highs that we've seen before. So this is looking fairly positive currently. We keep an eye on inflation. On top is a monthly chart of commodities, the CRB index, and it's been going pretty much sideways, but it's still in an uptrend because it's above its moving average. Then we take a ratio down below, inflation areas of commodities and deflation areas of commodities, and we're continuing to decline. Now, again, remember, this is a monthly chart, so this is going to take longer to develop. This is a daily chart here of the CRB index all by itself, where it is in an uptrend. Now, at some point, if this really continues to go up, these different areas that make up the CRB index, that may be considered inflationary and cause the market to have some fear. We look at the Baltic Dry Index. What does it cost to ship products from point A to point B, specifically in the Baltics? When this is in an uptrend, that tends to be more inflationary. When this is in a downtrend, that's more deflationary. And we're coming down here. We've been just kind of chopping more or less sideways. We're just beginning to see a death cross with this ratio, which would be more advantageous from an inflationary standpoint. Now we look at other markets, and I'm not involved in these other markets. I just look at them once a week. Here is aluminum, which is in an uptrend, but it's coming back down to its 50-day moving average. Corn has been in a downtrend. It came up to its 200-day moving average and now is starting to go back down. So that's not showing us really any inflationary signs. Wheat did break out, but is now coming back down after really declining. So that's still in a downtrend. We keep an eye on diesel, which has been going up a little bit as we're getting into the summer months. I'm sorry, this is fertilizer that we're seeing here. And that could be somewhat inflationary if it keeps going up because it costs more to buy fertilizer, and then that means it costs more to grow crops. Now we look at oil, which has been really chopping around. It spiked up when things started to go kind of crazy in the Middle East. It's since been coming down. It dropped below 80, got into the low 70s. Now it's getting back up into the high 70s. Keep an eye on gas, which is in an uptrend, but it's been falling back and falling below both its 50 and 200-day moving averages. This is diesel right here, where it is declining, and that could be more advantageous. This is more for 18-wheelers and for railroads. And with this going down, that just means this isn't an increase in what it costs to ship products. Heating oil, well, we're in the middle of summer now, but heating oil that doesn't mean much for that. Where we are seeing a decline and we are in a downtrend. Natural gas, which has been in a downtrend but starting to come back up, and we could be getting ready to see a bullish golden cross here. Copper, which is a barometer of the economy. Typically, when the economy is doing well, copper does well, leading. Now we're seeing a bit of a pullback. We're still in a positive trend here, but we fell below the 50-day moving average, and we're continuing to fall right now. So this is a little bit of a concern to us after it had been doing quite well. We look at copper and gold, and we take a ratio of that. When this was going up, that means copper was outperforming gold, even though gold has been doing quite well lately. Now copper has been starting to underperform. But when you look at this ratio, the blue line's above the red line, so that means that the copper to gold ratio is up, meaning that the trend is for copper to outperform gold. Here's a longer term look at that same chart where we really spiked up and now we're starting to come down. That's the black line that you see here. I also plot the 2-year yield in green and the 10-year yield in red, just to give us a little bit of context of how this is acting when compared to interest rates. Gold is in an uptrend, but it has been falling back lately. It came down below its 50-day moving average. Silver is just a little bit above its 50-day moving average, and it's also in an uptrend. Then we look at the closing price for gold on top. We look at the closing price for silver in the middle, and we see that there's a fairly strong correlation between the two. And that only makes sense. If gold's going up, typically silver will go up. If gold's going down, silver will probably be going down as well. Then we look at a gold to silver ratio on top. When this is going up, that means gold's outperforming silver. When this is going down, that means silver's outperforming gold. Then we plot the US dollar index in the middle, because sometimes there's a high correlation between the top chart and the middle chart. Right now, it's neutral, so it's not really giving us any insight. Here is the dollar all by itself, where it's in an uptrend on the daily chart. We did see some weakness, which has been giving some support to stocks, but now that it's getting back up into the 105 range, if it keeps going up, that could be more negative for stocks, since stocks prefer a weaker dollar for exchange rates and also for import and export prices. It works more to companies' favor if the dollar is going down. Here's another look going back 3 years where we finally broke above this trend line with the dollar, but now we've been coming back down. If we see more weakness in the dollar, I'll go ahead and extend this trend line, but we're not there yet. We keep an eye on the euro on top, and then this is the dollar index. And the euro is the biggest currency against the US dollar. So these are almost a mirror image, the top chart and the bottom chart. They're almost a complete reflection of each other. The Japanese yen is in a downtrend. We're pretty much going sideways right now with the euro, and we've been chopping kind of sideways in 2024 with the dollar. This is where we break out and look at the euro compared to the dollar. The blue line is still below the red line. We're dropping below both moving averages. So the euro is in a downtrend when compared to the dollar. The Japanese yen has been quite weak when compared to the dollar. And the British pound is still in an uptrend when compared to the US dollar. Then we look at some different index ratios, and I do show this in every daily video. The bar chart that you see here is the S&P 500, which is a weighted index. So when the really big companies are doing better, that means the S&P is outperforming the red line, which is an equal weight S&P 500, where all stocks are treated the same. You can see the red line is going down as the S&P has been going up. We look at a different ratio here. We take the equal weight and compare it to the S&P. When this is going down, that just means the big stocks are outperforming, as the equal weight stocks in the S&P are underperforming. We look at a ratio between stocks and commodities, showing how they're both in uptrends by themselves, but stocks are outperforming commodities. There's an inverse showing how commodities are underperforming stocks. Then we look at the NASDAQ 100 and the S&P 500, and they're both doing well. The NASDAQ 100 set an all-time high on Friday. The S&P set one earlier in the week. But this had been getting to the point where we almost saw a death cross here with this ratio. Now it's starting to go back up. That's meaning that the NASDAQ 100 is outperforming the S&P 500. The interesting thing about these two indexes is the main stocks in the S&P 100 are also in the S&P 500. And so that's why they have a tendency to perform fairly well. But according to this, the NASDAQ 100 is doing even better. We look at the S&P 100, the biggest stocks that make up the S&P 500. This is just really shooting up, showing that the larger stocks are outperforming the rest of the S&P. We look at the NASDAQ and compare it to the S&P 500. The NASDAQ is outperforming. It's actually been doing quite well. It set an all-time high in Friday's session, but the S&P has been doing well also, but the NASDAQ has been doing even better when you take a ratio. We look at the NASDAQ 100 and the NASDAQ and do a ratio. This is a little bit of a concern. We're seeing the NASDAQ 100 kind of starting to underperform the NASDAQ itself, enough to generate a death cross with this ratio. But the last week or so, the NASDAQ 100 has been coming on, because that includes NVIDIA and Apple, Microsoft, Google, these companies that typically have been doing quite well. But we've come right back up to the 50-day moving average with this ratio. We're wondering, is that going to provide overhead resistance, and then we're going to come down? Or are we going to be able to get above both of these lines and eventually turn back positive? We look at the mega cap. These are the real big companies, and compare it with the equal weight ratio, showing how the really, really big stocks are continuing to outperform. Small caps are underperforming. The red line is a ratio between small caps and the S&P, and this just continues to go down, down, down. We look at a ratio between small caps and the S&P, and it's also showing how the small caps are underperforming. The biggest software companies not doing all that great here. We're not seeing a lot of the bounce that we're seeing in other areas of the market. We're still positive here, but we could be getting ready to see a death cross with this ratio if we see more weakness in this area. The mega cap growth ETF, looking at this all by itself, it is in a solid uptrend, and that's the best performing area of the market currently. The robotics and AI ETF, it's in an uptrend and it's above its rainbow. Where it gets disturbing is when we compare it to the tech sector. It is really underperforming. It's dropping down outside of the rainbow and really showing a lot of weakness on a ratio basis, which is surprising because everybody's talking about AI these days. This is the Dow Jones Composite Average, where it takes the Dow, the transports, and the utilities and puts them together into one composite. And this has been pulling back. We're seeing some weakness in the Dow. The transports have been anemic in 2024. The utilities were coming on strong, but even they're seeing a bit of a pullback. We're still in a longer-term uptrend, and we have been since the beginning of 2024, but we're starting to drop and stay a little bit further below the 50-day moving average. We look at the S&P 500 and compare it with the price of 1 to 3 year bonds. This shows how stocks are outperforming. We look at the S&P 1500, also compare it with shorter term bonds, showing how stocks are outperforming. We're well above the rainbow. Another broad market measure, looking at further out bonds, showing that stocks are outperforming bonds, even on a broad market basis. This is a total U.S. stock ETF, which makes up 2,651 stocks. The last time I checked, we're just coming off of setting an all-time high here. So this is suggesting on a broad market basis that we're holding up fairly well currently. Low volatility ETF, it's in an uptrend, and it's still dealing with its 50-day moving average. But when we compare it to the S&P, it is massively underperforming. When this tends to outperform, this would be like what happened in 2022, when the low volatility stocks are actually outperforming the S&P. This going down is more positive for the market. We look at the tech sector and 3 to 7 year bonds, just showing how tech is very strong right now. We look at the advanced decline line studies, and this is another chart that I show in every daily video. It gives us more of a broad perspective of what's happening. We're seeing some weakness here. When we look at common stock on the NYSE, we're dropping below the moving average. The S&P is just barely starting to drop below its moving average. The mid caps and the small caps are showing more weakness currently. We look at traditional Dow theory on top, where we did set an all-time high, but then we've been bouncing down and then going sideways. The transports are really not looking good right now. The utilities had been strong, but now even they're starting to show a little bit of weakness. We look at the transports all by themselves, where we're just continuing to go down. We have not been able to get back to any of these previous highs, either in the shorter term or in the longer term, going back to the all-time high. We look at a ratio between the transports and S&P. When this is going down, that means the transports are underperforming, and that is what continues to happen. And we've been seeing that now for quite a while. We look at another ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming, and that's what's happening right now. We look at the relationship between the S&P on top and the transports. They're not having a strong relationship right now. They're having a slight tendency to even go in opposite directions. We want the transports to turn and go up for this market to be more positive. We look at a new idea behind Dow theory, where instead of using the Dow, we use the S&P. Instead of using the transports, we use the NASDAQ, because that's how our culture is based right now. We're just coming off of setting all-time highs with the S&P, and we're also coming off of a new all-time high set on Friday with the NASDAQ. So this is looking solid. Then this is another little further breakdown of Dow theory, where instead of using the S&P, we use the S&P equal weight index. Instead of using the NASDAQ, we use the QQQs, which is the NASDAQ 100, and then look at an equal weight ETF. This is a little bit of a concern. We're setting all-time highs with the S&P 500, but we never come back and set an all-time high with the equal weight index. It's really been underperforming. So this is a bit of a concern to us. We're also seeing that same thing with the QQQ's equal weight not coming back and setting a new high, even though the NASDAQ 100 has been doing that. So this just shows that the broader market, even in the S&P and the QQQs or NASDAQ 100, they are underperforming the really big stocks. The FANG index is just setting a new all-time high after Friday. This is Facebook, Apple, Amazon, Netflix, Google, and I'm sure NVIDIA is in there, and they've changed the acronym, but I just kept the old one. I just have this on here in case we see some weakness. I'll be looking for different areas of support, but we keep going up with the FANG index. The Wilshire 5000 is another broad market measure coming off of just setting a recent all-time high. So that's looking pretty solid. ARC is starting to show a death cross here with a downtrend. And this has been a real disappointment. There's a lot of people that got into this as it was going up. A lot of people got in right at the top, and it's just pretty much been going down. When we've been going up with other indexes, this at best has just been going sideways. We look at the all world ETF, but taking out US stocks, coming back down to its 50-day moving average, but still in an uptrend. Then we do a ratio between the SPY, which is the ETF for the S&P 500, and compare it with world stocks, taking out those US stocks. When this is going up, that means the SPY is outperforming world stocks. Here's a monthly chart looking at the S&P 500 and then another global measurement looking at stocks in Europe, Australia, Asia, and the Far East. We continue to go up and we're above an advancing moving average. And again, this is a monthly chart. So this is longer term showing how the S&P 500 is outperforming stocks in other countries. We're starting to go back up with the PPO, which is a momentum oscillator. And we look at bonds, which are seeing an improvement. When this goes up, that means interest rates are going down and we're still in an uptrend. And we look at the Pring World Bond Index. This is actually starting to turn negative. We're chopping back lower, and the blue line is now starting to cross below the red line. So that's turning negative. We look at a stock to bond ratio on a monthly chart. We tick down just a little bit here, but it's just showing how stocks are outperforming bonds. This is a daily chart showing how bonds are underperforming stocks as we continue to decline. High yield corporate bonds, these are junk bonds, and they're just coming off of setting recent all-time highs. They're riskier, but they give a better return. And in the current environment that we've been in, folks have been preferring to get into junk bonds rather than the safer government bonds. So the next ETF are government bonds, where we're in an uptrend and we're looking okay, but we have a long ways to go back to these previous all-time highs. This is kind of interesting, and this is telling us that maybe we're seeing a bit of a shift. We do a ratio between riskier bonds or junk bonds and the more conservative bonds like government bonds, and this has been riding above the rainbow for quite some time. Well, now, as interest rates are coming down, we're seeing this ratio coming down. This could mean, we'll have to watch this played out over a period of time, that folks are getting out of the junk bonds and starting to get into more conservative bonds. That's when they feel like we've topped out with interest rates. We look at a correlation between stocks and bonds, fairly strong tendency to go in the same direction. Now, this is bonds based on price, not based on their interest rate or yield. So if bonds are up lately, typically stocks are up as well. We look at the corporate bond index, where this is finally showing some life in here. We're not quite back above these previous highs, but we are in an uptrend and above both moving averages. We look at the 10-year yield and put some Fibonacci studies on here. We're just kind of in between these different levels. And in the daily videos, this is the chart I was talking about when we, for 40 years, were in a lowering interest rate environment. Now it looks like that could be shifting over to a higher interest rate environment. This higher environment is actually the norm. This 40-year decline that we saw here is actually the exception to the rule. And so we're just keeping an eye on this, and we just may be getting into a higher interest rate environment. We do a 30-year yield Fibonacci study here, and we're in between all of the retracement levels, so there's nothing to see here. The S&P 500 is back to outperforming the 10-year yield. as stocks outperform interest rates. And this is also showing how bonds are underperforming stocks. When this ratio is going down, that means that stocks are outperforming. And I've been showing this chart quite often in the daily videos. We want this ratio to continue to go down if we're going to stay positive on the market with stocks. Junk bonds are coming off just setting new all-time highs. We look at a ratio between junk bonds and more conservative government bonds. This is still in an uptrend, showing that junk bonds are outperforming, but you can see how we're starting to pull back. If this continues, we might be starting to see a shift in the bond market from more risky bonds to less risky bonds. This is based on price. This is looking at the 7 to 10-year bond ETF, where lately it's been really going up. And here's a daily chart of yields across the spectrum, where lately interest rates have been coming down. Here's a weekly chart looking internationally, where we're declining with US, UK, German, and even Japanese rates. We look at the MOVE index on top, which measures the volatility of bonds. This is a fairly new index, so doing any historical type of analysis is very difficult with this. Where in the middle area, this is the VIX. This measures the volatility of stocks. They're having a fairly strong relationship when we look at the volatility. This isn't looking at price. This is just looking at the volatility of bonds to stocks, and they're both kind of going in the same direction as far as volatility is concerned. Here's a monthly chart of the 30-year bond, where it's been in a decline. We're possibly starting to break above the moving average. That could be positive. But when you do another ratio between the long-term bond ETF and commodities, bonds continue to outperform. Then we look at different sectors. And first I look at just a regular sector chart, and there's 11 sectors that make up the S&P. And then the chart right after this is going to compare how is this sector performing in relation to the S&P 500. But we have seen some recent pullbacks here with materials, but we're still in an uptrend. Where it gets interesting is when we look at a ratio, where it's in a downtrend, and over the past few trading sessions, this ratio has really gone down, showing materials are underperforming. Communication, this is one of the stronger areas of the market. We're off our highs, but we're still in an uptrend, and it's trying to tick back up here. It had really been outperforming, and then we saw some weakness. We're still battling with the 200-day moving average with this ratio. To be even more positive, we want to see this continue to go up. We look at energy, which is coming all the way down to its 200-day moving average, and so far it's still above that, but it's really underperforming when we compare energy with the S&P 500. Financials had been strong, but starting to see some weakness and dropping further below their 50-day moving average. And we look at a ratio where the financials are really starting to underperform the S&P. This had been an uptrend showing that financials were outperforming, but we could be seeing that change if this continues. The industrials are in an uptrend by themselves, but still below their 50-day moving average. They're also really starting to underperform the rest of the S&P. Tech, another darling area, going out and setting new all-time highs with this sector, and actually showing an outperformance when we look at a ratio with the S&P. This is the strongest area of the market. We look at the staple sector, which is in an uptrend, and this is more defensive. We were starting to get concerned about this because if this is really going up, this is typically what happens before the market is getting set to have some problems. You can see back in 2021 where this was really doing well. And then when we got into 2022, yeah, this area was pretty choppy, but it held up a lot better than some of the other areas of the market. But when we look at this on a ratio basis, staples are back to clearly underperforming the S&P. We look at real estate, which is in an uptrend. When we look at it all by itself, it's really underperforming when we compare it to the S&P 500. Utilities, which have been screaming to the upside, but lately have been pulling back, and they're not quite back to their 50-day moving average. And when we look at a ratio, we saw the strength as the utilities were outperforming going back to the end of March up until about the latter part of May. Now this is starting to fall down, even though we've seen a recent death cross with this ratio. The S&P to utilities ratio has been coming down. Now it's starting to go back up, and that's more positive for the S&P. We look at healthcare, another defensive area, since you have to have healthcare no matter what's happening economically. It's in an uptrend when we look at it all by itself, but it's really underperforming when we compare it to the S&P. Discretionary, still in an uptrend, been an area of some disappointment here. It's still above its 50-day moving average, but it's really underperforming the S&P 500. The semiconductors, again, it's kind of like a sub-sector. I usually refer to this as an industry group. Well, this is more, it's so important, and it's such a big part of the tech sector. This is like a sector of a sector. But this is in a solid uptrend and just setting all-time highs. Then we do a ratio between energy and tech, showing how energy has been underperforming. Energy was showing a bit of a comeback here, but now it's starting to go down and underperform, and we're still in a longer-term downtrend with this ratio. We look at growth stocks, which continue to outperform government bonds. And we look at the tech sector and compare it with the 10-year yield, showing how the tech sector is outperforming. Here's an inverse showing how the 10-year yield is underperforming the tech sector. Discretionary versus staples, we want to see this doing better, but this has not been doing well, especially over the last few months, and it's actually turned with a death cross here and turned negative with this ratio. This is a concern of ours, and a lot of that is being caused by weakness in Tesla. Then we look at an inverse showing how staples are outperforming discretionary, even though this has been coming down lately. We want to see this go down on this chart, and on the previous chart, we want to see it going up to be more positive. And then here's a discretionary to staples ratio, again, showing how it's underperforming. Didn't I just show this? Okay, must have hit the wrong button somewhere along the line. We look at gold to the S&P, and even though gold's been all the rage and people have been talking about it, we do see a recent golden cross with this ratio, but now it's been pulling back. So really gold has not necessarily been outperforming the S&P 500. We also look at gold versus the dollar, where it finally broke out above this red trend line and then a longer term blue trend line. And it's been just kind of chopping sideways recently. High leverage loans, and I always talk about this. These are very risky loans, and people that get into this ETF, they're not dumb. They really follow what's going on, but you can see we're just really in a solid uptrend here. We barely come down to the 50-day moving average. This suggests that according to the people in this ETF, things are still looking quite positive economically. The NYSE composite has dropped below its 50-day moving average, but it's still in an uptrend. All stocks are in an uptrend, and those are US and international stocks taken together. Emerging markets showing a little bit of an improvement here and in an uptrend. The Japanese Nikkei index is still not quite back to its previous high here. It set a high back in 1989. It was finally able to go above that. Then it had been dropping below it. We'll see if it can get back above it again. Microcaps, smaller companies, in an uptrend, but falling below its 50-day moving average. And then we look at a home builder study here, and I'm not going to take time to explain this because we're really not getting anything from this chart. Bitcoin, which has been doing okay, but it's really falling back over the last few sessions. It had been able to get above 70,000. Now it's starting to drop into the mid 60s. And then we look at a a weekly chart internationally using a different oscillator called the KST, where Chinese stocks are in a downtrend. Emerging markets are in a downtrend. Europe is in an uptrend, but we're seeing some weakness there as there's some political instability in France concerning elections and whether they're going to stay in the EU. And then the Japanese stocks are in a downtrend. We're starting to turn up, but we had been flat here when we look at US stocks as measured by the S&P. This is an intermarket analysis chart going back to the beginning of the year, showing that stocks are performing the best, followed by oil, then gold, then the dollar. Bonds are improving based on price, but they're still negative on the year. Then we look at some correlations, and we're seeing a real strong correlation between the S&P and the dollar. Now, lately, when this gets down here, if the dollar is up, that will pressure stocks. But this is starting to change, showing that the dollar and stocks can both go up or down together at the same time. And we're looking at a correlation between the S&P 500 and oil. Also, oil is typically going up when stocks are going up. Now, this was turning negative especially back in October. It was really bouncing all around as there was some unrest in the Middle East. That's where a lot of oil comes from. And you can look at oil as a growth area when the companies are doing well and the price of oil continues to go up. But when oil goes up for geopolitical reasons, that kind of changes the whole scenario, and they have a tendency to move in opposite directions. As oil hasn't really been shooting higher, we're seeing this correlation actually getting stronger. And we look at the S&P to the 10-year yield, they're having a slight tendency to go in opposite directions. If interest rates are down, that typically is helping stocks. We also look at the 10-year yield compared to tech, and also a tendency to go in opposite directions. And then the S&P to the 2-year yield, also pretty strong, but not really strong tendency to go in opposite directions. We look at some long-term secular, which can mean decades, and cyclical trend studies, which usually means possibly years, months to years. This is a monthly chart of the NYSE composite. We're above the red line and still going up. So this is a broad market measure, longer term with the monthly chart. We're also looking positive here when we use a momentum oscillator called the Copic curve to measure this overall momentum. This is a daily chart where we have been really going up with this indicator. Now we're starting to drop back down just a little bit. Now we look at the S&P, and this is a monthly chart. We're above the red line, which is a moving average. So clearly we're in an uptrend longer term. We're starting to turn back up with this momentum oscillator as it's going up and advancing. Then we look at the S&P on top. This is a daily chart, and we do a ratio between the S&P and the CRB index. This continues to show that the S&P is outperforming commodities, even though they're both in uptrends right now. Then we look at the Dow Jones, or excuse me, the S&P and Dow Jones Global Index on a monthly basis. This is showing how the S&P is outperforming. The momentum oscillator used here is the KST, and they're pretty much on top of each other. And then at the very end, I take a list of all those things that are positive. And my definition of positive for this video is when the 50-day simple moving average is above the 200-day simple moving average. We have the growth indexes when you look at them by themselves, as well as the value indexes. Copper's in an uptrend, but pulling back lately. The British pound against the US dollar. Gold is in an uptrend. Silver's in an uptrend. The dollar's in an uptrend. The CRB index is in an uptrend. We're seeing some weakness with the big software companies, but they're still hanging on to an uptrend. The mega caps, that's where the real strength in the indexes is coming from. The FANG index is setting all-time highs. Low volatility stocks are in an uptrend by themselves, but when you compare it to the S&P, they're massively underperforming. Staples are in an uptrend, again, a more defensive area. The Dow Jones Composite average, even though the Dow's been weak and utilities are pulling back and the transports have really not been performing well, it's still in an uptrend. We look at bonds based on price with total bonds, high yield bonds, investment grade bonds, corporate bonds, junk bonds. There was one that I removed off of here, and that's the World Bond Index. The tech sector and semiconductors are in uptrends. The high leverage loans are still looking really good. The Dow's in an uptrend, even though it's been not really performing all that well. The NYSE Composite and Wilshire, those are broad market measures, and they're still hanging in there and looking good. The NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps. Even though the small caps have been a disappointment, they're still in a longer term uptrend. All stocks, emerging markets, and then very at the bottom is the Bitcoin index. Then we have a few things added to the negative side. This is when the 50-day moving average goes below its 200-day moving average. The Japanese yen when compared to the US dollar, the euro against the US dollar, and now ARK has been added to that list, and the Pring World Bond Index. So we had a couple of new additions this week. Thank you. I really hope you found this helpful. Please check out, especially the daily videos. That's where I do my deepest analysis. But I know people can't always do that. You might at least check out the weekly video update that I do. I hope you have a great weekend, and I will talk to you in the next video.